to another earnings conversation. Brigade Hotel Ventures posted a good June quarter with revenue and EBITDA growth. The company also turned to profit in Q1, and we are now being joined by Nirupa Shankar, who's the Managing Director, to break down the quarter and the road ahead. Well, good morning to you, Ms. Shankar. This is Vamakshi joining in. I'd first like to start off by asking you about the pipeline for hotel addition. You have around 9 hotels with 1,700 keys in the pipeline. So when would they come on stream in FY26 and in FY27? What would the trajectory look like?
Thank you. Good morning. Thanks so much for having me, Vamakshi. Happy to share the details of our past quarter. So you're right. In terms of the new hotels that are coming up, we do have 9 in the pipeline where we've tied up the land and the brand. Obviously, we are builders and real estate builders, so we build all our hotels greenfield as of now, and that's the plan. So most of the hotels will start coming in only by FY28, 29, and FY30. So that's how the massive growth plan will come in only in FY28 onwards. However, over the next couple of years, what we have in mind is we are launching a 45 key hotel. It's part of our mixed-use township in the World Trade Center, Chennai. So that the shell created pre-COVID, and then then it was put on hold, obviously during COVID, and now we've decided that we will continue with the hotel. So that should take about a year to come up, but that will come up. It's still relatively small, but again, it's an addition to the portfolio. And apart from that, as part of our IPO proceeds, we had allocated about 90 odd crores for an unidentified acquisition. So right now our focus is to work on business development to figure out what is that asset that we plan to invest in. Because thus far, all our growth has been organic. We've done greenfield. We believe that's our USP, and we're able to build very cost effectively and efficiently. But hotels are asset classes that do take time to build. So this is the plan that we have in mind. 45 rooms will come up maybe in next fiscal, and then we are also on the lookout for an asset to buy.
All right. Hi, Nirupa. Good to see you in. So from around 1,600 keys that we have as of last count, where is that number headed with that addition plan that you're talking about? If you could help us out with that number. And also your ARR, how do you see it move up from year on as these 5-star hotels do get added to your kitty?
Yeah. So the 1,600 keys that we have operating now with the addition of 1,700 that we have already tied up will move to 3,300. But the ARR with the existing portfolio, because some of them have already been stabilized in the sense that they've been operating for a while, we are not projecting extremely over-optimistic numbers. We've been fairly conservative in our projected ADR growth rate. We are looking at double-digit growth rate, but conservative, around 10%, 10 to 12% on good quarters. Some quarters it might be 1 or 2% lower. Some quarters it may be higher, but obviously we are going to push for higher ADR, but we don't want to really be over-optimistic. We want to take a conservative view on that. And in terms of once the portfolio changes, currently the portfolio, at least 50% of our portfolio are in tier 2 and tier 3 markets, be it Kochi, Gift City, Mysore. So these markets, the ADR is relatively low, and also we don't expect them to significantly grow. However, when we have our new hotels come up and the positioning of those are 5-star deluxe hotels, one is, the Intercon in Hyderabad, one is the Grand Hyatt in Chennai, one is potentially another luxury island resort in Kochi. So then obviously we expect to see significant change in the portfolio. It would be too premature of me to give you, an exact number today because these hotels will come up only in FY28, 29. But the idea is that you will see a significant enhancement in the ADR just because of the positioning of the hotels.
Sure. And, so how does this double-digit sort of ARR growth that you're factoring in, translate to the growth for the top line, number one? And number two is, what is the kind of margin profile that you expect for FY26?
Yeah. So, in terms of the overall ADR growth, generally the H1 of each fiscal is on the slower side, and we should see a better fiscal or rather better H2 in the latter part of the fiscal. Our portfolio is pretty well stabilized on the occupancy side. It has this quarter had about 75% average occupancy. Of course, we do believe that the occupancy has room to grow, but the 75% is a relatively good occupancy. So now the focus should be on enhancing ADR. Although some of the hotels perform in the mid 80s, at the portfolio level, we do have some hotels that have just launched. For instance, our Grand Mercure and Ibis style. In the third quarter itself, it saw a good jump to about 68. So occupancy is, of course, one lever. ADR is the other lever. But, of course, ADR is always market driven. Right now, our EBITDA margins are around 35%. And we do expect that we do expect an increase in that margin in the latter part of H2.
All right, Nirupa, it's good having you on the show. We enjoy our conversations with the Brigade Group itself, and we look forward to chatting up with you as business does evolve.
Thanks so much. Good seeing you as well. Bye-bye.
Well, on that note, though, we'll wrap up on this edition of